Okay, Teradyne just proved that more than 60% of their business is now directly feeding the AI boom. But if you look at the tape today, you'd think they announced a massive crisis. Welcome to Earnings Unscripted. It's July 29th, 2026, and we're unpacking Q2 for Teradyne, ticker TER.
Yeah, that overnight trading was genuinely violent. They comfortably beat the high end of their guidance, but the regular session just completely erased a massive after-hours price spike.
Right. Total revenue came in at a record $1.3 billion, which basically doubled year over year, and EPS landed at $2.47. So they completely crushed it, but the stock ultimately closed at a slight net loss for the day, which honestly makes this a great moment to remind everyone we're not giving financial advice here, just sharing our personal market theories. So please don't redesign your portfolio based on our banter.
Trying to trade overnight gap fills is a terrible idea anyway. But look, the eventual sell-off actually makes sense when you dig into the profitability narrative.
Because of the margins, right? They warned things are going to tighten up in the back half of the year and just kind of...
Well, the product mix is actively shifting against them. High-margin compute testing is hitting a temporary lull due to order timing, while demand for memory testing, especially high-bandwidth memory, is surging right now.
Okay, wait, let me process that. High bandwidth memory is the exact component every single hyperscaler is desperate for right now. So a huge surge in testing it should be the ultimate win for them, no?
Volume-wise, sure. Margin-wise, definitely not. The CFO bluntly called memory a structural strain on their overall gross margins, and she warned that headwind is going to drag all the way into 2027.
Okay. The classic volume versus premium problem. They're making plenty of cash. They're just netting slightly less profit on every incremental machine heading out the door.
Right, and they're still aggressively ramping operating expenses right through that squeeze to hold their ground with the big cloud giants. They basically have to.
Which perfectly sets up this incredibly bizarre story from the CEO on the call. He was describing an exploratory meeting with a client about next-gen optical testing, this highly complex phase called insertion 2, and realized 15 minutes in that nobody at the table actually shared the same definition for what they were physically building.
That right there is the perfect encapsulation of where this industry is today. You have these brilliant engineers trying to test co-packaged optics, but they're literally inventing the workflow on the fly. It isn't just digital logic anymore. Some of these tests physically can't happen until the polymer lenses actually get attached to the silicon.
So wait, usually you just, plug a chip in and run a diagnostic before it gets fully assembled, right? But with photonics, you're saying they have to basically finish the hardware build before they even know if the thing works?
It's not the entire build, but yes, you have to add these incredibly fragile optical components early in the process, and that completely breaks the traditional yield model. If a single die in a massive AI cluster fails after you've attached the lenses, the financial penalty is catastrophic. That's why Teradyne's automated equipment is becoming essentially an insurance policy for the hyperscalers.
An insurance policy that I assume costs a small fortune.
Right, but the alternative is a busted server farm, and that leads into a much bigger dynamic buried in the filings. The big cloud giants are actively trying to strip pricing power away from equipment vendors by mandating a strict dual vendor framework.
So instead of buying from one trusted supplier, they intentionally split the order, just to keep everyone fighting for the scraps?
Exactly. It prevents single vendor lock-in. Big tech demands supply chain security above all else. But Teradyne is openly weaponizing this dynamic. They're leveraging their position as a fast follower at the cloud giants to break competitor moats. The CEO, Greg Smith, was totally blunt about it. He said, "Our customers are quite adept at choosing the best solution at each stage, so we have to really compete for everything that we're getting."
Which sounds exhausting to manage, but if the overall pie is growing, grabbing a smaller slice of a much bigger addressable market still works, right? Because they mentioned global semiconductor fab equipment spending is barreling towards $250 billion by the end of the decade.
Yeah, and Smith thinks the total addressable market for just the testing side can cross $20 billion. But here's the uncomfortable part. Test spending historically correlates to about 4 to 8% of overall fabrication capex.
Okay.
Right now, it's sitting at the absolute top end of that range, but management actively warned it might slip back down closer to 7%. And what that tells you is this industry is facing a highly uneven whipsaw cycle. Foundational fab growth and test demand are actually decoupling.
Okay, wait. Walk me through that again. Decoupling, how? If someone builds a giant new chip factory, they have to buy the test machines to match it, don't they? Isn't it just a one-to-one capital expense?
No, that's the trap everyone falls into. Testing is a lagging indicator. You build the fab, you lay the silicon, and there's usually a 3-quarter delay before the test equipment orders actually hit Teradyne's books. But right now, because multi-die AI clusters are so dense, that timing is completely distorted. You get explosive order spikes followed by sudden air pockets.
Oh, which completely explains why they were warning about an order timing dip hurting their compute segment in the back half of the year. They're just hitting one of those air pockets.
Spot on. The huge network capacity they sold earlier this year is just now being digested by the hyperscalers. The next major surge for those same customers isn't expected to hit until the first half of next year.
So if you're an investor staring at this right now, you're basically expected to stomach 6 months of choppy orders and compressed margins while the company spends heavily on R&D just to maintain their footing for next year's bounce?
Pretty much. But it's not just about maintaining their footing. You don't slash your research budget when you're trying to invent a standard for silicon photonics from scratch. If they flinch on spending right now, they completely lose the next hardware cycle.
Which makes total sense. I mean, you can't just pause the future because smartphone sales had a bad season. And management clearly agrees because they're guiding third quarter revenue somewhere between 1.2 and 1.3 billion. So definitely a slight step down from the quarter we just wrapped.
Right, because of that exact air pocket. Greg Smith actually framed it perfectly on the call. He said, the next surge for these customers is expected to be in the first half of 2027. So they're essentially just preheating the oven while keeping operating expenses elevated near 30% of sales.
Preheating the oven. That's a good way to put it. And in the meantime, it's wild what's actually carrying them through this lull. Their robotics division was up 33% year over year, basically because the cloud giants use Teradyne's automation to physically assemble these massive facilities.
Yeah, they're playing both ends of the supply chain. They test the brains of the data center, and then they sell the robots that bolt the whole thing together.
It's the ultimate pick and shovel play. They just need investors to actually hold the stock while the concrete dries on all this infrastructure.
Patience on Wall Street? Good luck with that.
Fair enough. I guess we'll find out who has the stomach for it in a few months.
Catch you next time.
If you liked this breakdown, consider adding us to your regular podcast rotation. Since we've been talking so much about automation today, it's only fair to mention that this entire podcast is an AI experiment. Both of our voices are synthetic and the script's completely AI generated, letting us turn this around from the earnings call to your feed the very same day. We're always taking requests for future tickers, so shoot an email to earningsunscripted@datamadness.ca or find the X link in the show notes.
Talk soon.